Hey guys, Mike here. So, oh boy, what a day in the market, man. End up getting some more inflation data, and at first the markets really didn't like it, but surprisingly, it wasn't anywhere near as bad as I think people thought it was going to be. There is a reason for this. We're actually going to try to learn something today, which is what I like to do and stuff. And then we're going to go into something else that's going to affect the consumer. Remember, I've always talked about a certain income bracket that's getting crushed under high inflation. Well, that's about to get worse, okay? And I'm going to show you that right there. And then we'll go into the charts because there's something we're going to find out next week, whether or not we're actually going back down and actually proceeding on with this bear market, or are we just retesting the breakout? And I'll show you exactly what I'm talking about, and a couple other charts that are hitting some really key support levels or broke the key support levels today. So that's something we got to be looking at. But here's something somebody put in the Discord, one of our members, and he wants to remain anonymous. And so he knows who he is, so I really appreciate it. But it's the best visual I've ever seen when it comes to explaining what is happening when options are being sold, and especially the ODTEs. We're going to get into that as well. This is titled "How a Small Trader's Call Option Results in Buying Demand," and it can result in a lot of buying demand. So now we're going to zoom in a little bit more here, and this is Amazon. And understand this was made when Amazon was trading like around $3,000 a share. Okay. And so this is how this works. A small trader buys an Amazon call. Now the market maker turns around, since he sold the option, right? And he buys 21 Amazon shares to hedge at a delta of 21%. Now this is the key to understand this. So delta, it's one of the Greeks when it's talking about options. It measures how much an option's price can be expected to move for every $1 change in the price of the underlying security for the index. For example, if a delta has 0.40, means the option price will theoretically move 40 cents for every dollar that stock or index moves, okay? So now going back, the Amazon shares rise 1.1%. So what happens? The market maker goes back and he buys 5 more shares to hedge. That gives it a delta of 26%. Notice the delta is going up, right? And so what happens? Amazon shares now rise 4.1%, because what happens when you buy stock, right? We buy the share of something that usually goes up, right? So now what happens when it goes up 4.1%? Now you're talking about a gamma explosion, okay? So now the option delta jumps. The market maker now has to buy another 47 shares, and that puts the delta at 73%. So the delta has gone from 21% now to 73%. So now that small trader's initial $1,500 outlay results in $230,000 worth of stock being bought. Now, the $230,000 is Amazon's over $3,000 when this example was wrote up, and they bought, I believe it was a total of 73 shares, if I'm not mistaken, right there. And then, more importantly, this is the thing to really understand. You see this happening a lot now. When options expire, hedges need to be unwound. Now, why is this important to understand? Because of what happened yesterday in the market. These ODTE options we talk about, it's not just retail investors. The big boys are getting in these too. And this is what happened yesterday. Yesterday, we had obviously a V-shaped type recovery. We sold off and then recovered. And what caused it was very simple, actually. 26,000 February 23rd put options on the S&P 500 E-minis futures with a strike corresponding to the 4,000 level were bought early in Thursday's session. And this is just what we talked about, but the opposite. So when a trader buys a put, an option contract that conveys the right to sell security at a fixed price, the option dealer, the market maker, has to hedge, and they will sell that stock. Okay, so that's why you see these huge moves ups and downs, right? When you see these big block orders coming through on the options. And so in addition, very important here, as the market declines, the options dealers have to sell increasing amounts of stock futures to remain hedged. It's the same thing you just saw in the Amazon example. It's up with pictures, right? Those trades generated some $2 billion in selling pressure and likely contributed to the index intraday reversal yesterday. And the thing to watch out for is what people are really looking for. Selling pressure could rise as much as $5 billion if the market continues to decline and force the hedging to increase. And so hopefully rewind it, watch it. Hopefully that makes at least some sense. Just don't worry about getting detailed about it. Just grasp the overall concept of what's happening here. But that's why if you look on like an S&P chart, you're seeing like these V-shape, right? This huge sell off in the morning. You go, oh, it must be the news. And then all of a sudden, it recovers, right? And so it's not just us buying these, it is the big boys buying it and taking advantage of the situation right now. And so people are kind of worried. That's what they were saying. If we get too far outside this weekly range, it's going to cause even more hedging, which means more selling of stocks. And so we'll have to wait and see on that. But again, hopefully that makes sense. Let me know in the comments if you kind of grasp it. And also let me know in the comments if that didn't explain it clearly enough. And I'll try to go back over it. But what happened this morning was we had more hot inflation data, which I don't know why anybody's surprised about this. But you had the PCE, which of course the Fed just loves to use. And so it was 5.4% year over year versus 5% estimated. Prior year was 5.3, revved up from 5%, so they had to go and redo it. Core PCE, which this is what the Fed loves, 4.7% versus 4.3% estimated, and 4.6% prior, revved up from 4.4. And again, I don't understand why people are surprised by this. We just got other hot data before this. So, I mean, I think shouldn't everybody know this was going to come in a little bit hotter than expected. I don't think anything would come in this hot. But again, you know, and I guess, I don't know, I don't think any of us are surprised. Please let me know in the comments if you are about inflation going up, because what we've been talking about for months. When China reopens, right? When the Fed allowed the market just to take off, I showed you guys what? All those commodity prices just roaring back up. And what we knew that was going to happen. We knew inflation was going to come back. We just didn't know, like I said in multiple videos, how long it would take to cycle into the numbers, you know? And then what we got to figure out next month, we get to gauge this. How much is just the fact you guys changed the weights and the calculations, right? I mean, if you change the rule in the middle of the game, something's probably going to happen differently, right? You might be disappointed, you might be happy about it, but again, we have to see that as well. And so, you know, I don't know why people are surprised by it. Oh my goodness, I can't believe it. But again, what are you know, people saying? Oh my God, they're going to be even more hawkish. They're going to have to raise rates even more and hold them longer. And I mean, again, the Fed's been saying that, so we'll see if they do it or not, carry through it. Again, they don't like to shock the markets. And so, of course, that's why you see the market selling off. It's trying to, all of a sudden you see like 50 basis point hikes or the idea of that happening or even more now. The odds of that happening are even more now. And will they do a 75? I'm seeing that go around Twitter. I'm like, oh, Lord. You know, which the truth is, I mean, look, I was the guy back there saying they shouldn't ramp it down at all. Just keep it 75, just get it over with, right? But no, and as soon as they start ramping those things down, 50 to 25, that's when the market's like, this is it. This is what they do before every pause. And boom. And Jerome Powell, once again, had a chance to stomp it out many times and just said, nope, do your thing. And so that was that. And then those, you know, the minutes we got the other day, that's old news. That shouldn't even really matter because the inflation, you change the calculation, inflation is not going down as fast as it was, right? And so those minutes shouldn't really mean anything anyway. And so anyway, the other thing I want to talk to you about before we get into the charts is, you know, we talked about many times, and I grew up poor, so I can use the word poor, all right? Some people think it's, you know, a bad word to use, but I grew up there, so I'm going to use it. And, you know, there's a certain income bracket, I don't know what the magic number is, but X amount and below that are being crushed, right? By all the inflation, all the increased prices and stuff they're paying for, right? And when you're poor, every dollar counts. Remember that phrase. Well, somebody put in the comments, and I read every comment, it was something about SNAP, right? I don't know a lot about SNAP, I'll be honest with you. But I looked at this, and of course my home state is Alabama, and we're number one in SNAP. And what's crazy about this is 1 in every 7 people that live in Alabama are on some kind of SNAP program or some part of SNAP program, right? 50% of the state population, which is just sad. What's even worse to me is in America, 1 in every 8, right? 1 out of every 8 Americans are on the SNAP programs, almost 12% of the population. Now, why do I bring that up? Somebody said this in the comments. I looked it up and I verified it. Because temporary pandemic SNAP benefits will end next month. And if you look and you're thinking when you read this, every household in those states will receive at least $95 a month less. Some households who under regular SNAP rules receiving low benefits because they have somewhat higher but still modest incomes will have a reduction of $250 a month or more. The average person around $90. And guys, if you're getting anything out of this, please hit that like button. It really does help the channel. And if you're new here and you like this kind of content, think about hitting the subscribe button. I really appreciate it. Now, I know you're thinking, and if this thought crosses your mind, $90 a month, really? Really? Like, how's it going to affect anybody? That lets me know, and no shame at all, you didn't grow up poor. You're lucky. I applaud you, and trust me, you were lucky not to. Okay? But, you know, yes, when you're poor, every dollar counts. Hit me up in the comments. If you grew up poor, you understand exactly what I'm talking about. All right? And so you're already talking about a group of people, a whole lot of people, millions, that are already suffering. Now you're going to take more money away from them while inflation is still extremely high, while rates are extremely high. Okay, let me tell you one common thing about poor people, right, because I grew up there. The credit scores are terrible. Okay, so imagine, and that's one reason people stay poor. I've done studies on this. that the reason why I know for my family, we were bankrupt twice. Why? Because of medical bills, not because they couldn't handle the finances, because of medical bills. And it's a great thing about America. The number one reason for bankruptcy 30-something years later is still medical bills, which is a shame, by the way. But, you know, what happened to our credit score, my mom and stepdad's, it sucked. And so what happens? When you go try to get a car to use car lot, they charge you, it's like, what do they call it? You know, I'm trying to think of the word, people who gamble and stuff, loan shark. Loan shark rates, insane rates, right? So you can like never pay the car off. It's crazy, but that's what happens, right? So that takes more money out of your pocket, okay? So and it's just a vicious cycle. And so, you know, so that's going to happen. So that's going to weaken that group of consumers who still have to buy groceries and things like that. But now they're going to be buying less because you got to take thousands of households and multiply that by an average of $90. It adds up. That is more money, liquidity, coming out of the market being spent. That's just the way it is, right? And it doesn't matter what you know, I know a lot of people have strong opinions on that subject. I'm not bringing it up for that reason. I'm just telling you right now. So those people are going to suffer even more. That's less money being spent out there on groceries and things of that nature. And so keep that in mind coming March, April, May. Okay, so that will speed up this process of weakening the consumer. Because right now, I mean, we're running the credit cards up. We're still strong. We're still paying the bills off because we still have jobs. Okay, now getting into the market. This is the big one. This is the big question going into next week. Obviously ended up slightly red. Now, where do we end up at? Right on top of the 200-day moving average, but also on top of the trend line that we broke out of, which leads us right back down that channel we were in for over a year. And so the question is, are we just testing what we broke out of, or are we going to start going back into the bear market? That's what we have to find out. Again, it's like a soap opera. Why did they leave us there? Why don't we just break right on through it and head down? Because we got to get you to come back for more. Okay, remember, that's what this is all about. I'm just kidding, but it's true. It seems that way, right? Now, if we're going on a smaller time frame, you can see bounce right off of it. That 200 also is there as support at the time. We're leaving gap after gap behind. And if you're in TradingView or whatever and you want to find an automatic way to fill these gaps for you so you can see them, just go up here and type in gaps, some kind of new indicator they have, and it'll fill them in for you, the ones that have been filled in and the ones that need to be filled in. And as you can see, we got some gaps right here. All right, so 2 gaps above us that have not been filled, maybe 3 actually, that I'm looking at it. And so remember, 90% of gaps fill. So we'll have to see how that goes. But if we also look here, where's the 200 right now and where are we sitting? We're sitting right above that 618 Fibonacci level. So that's usually sometimes where you get reversals, and it's almost like coinciding right with that downward trend line right there. So next week's going to be key to see if we go just fall right back into it. And people say, oh, we're back in the bear market. Or are we just retesting where we broke out of? And so that's going to be key. But then that leads us to Tesla. And obviously I said yesterday, hey, until it breaks that trend line, which has bounced off up multiple times, you know, let's talk about it later. But guess what? It gapped down, broke right through it, and could not get back above it today. And so now that definitely leads to lower levels being available for sure. As you can see right there, we broke out of it, but it did respect it for a while. And so the key is looking at this, is it going to break back above that trend line? Because that's what I'm expecting to go back up and retest before the reject. That's usually what happens. You'll get a retest of it and see if it can turn not only that, but that 200 level back into support, which is now resistance, or not, because it's been busting back above it, but it can't hold the 200 line. And so that's what I'll be looking for next week. You already got the bearish MACD crossover on the daily. We'll have to see. Can it get back above that anchor VWAP as well, which it respected for quite a while. We'll have to see on that as well. And then that leads us to Meta. And Meta, you can see right here at 2022 anchor VWAP we talked about. It broke down today, gapped down, so it left another gap within a gap. And so right below that, that all of a sudden puts this in play, the 2023 anchored VWAP, which sits around that 161 level, as you can see right there. And so are we going to go back up and fill the gap first, or what's going to happen? If we get a reversal in the market, you know, it's guaranteed it's going to move up, get above the anchored VWAP. If we continue down, the markets that is, then of course, yes, you're talking about only about a 4.5% move down to reach that as well. And of course, the things to watch out for too coming up this week, and this is what I was looking for right here, the 2-year Treasury yield. There was this trend line right here, and I was waiting to see if we come up and retest and reject or actually break above it. That had been set in place for over a year. You can see we broke through it, couldn't hold it. So that is still resistance. If it does reject off of it and start heading back down, that is going to be bullish for the markets, especially tech. And if you look at the dollars, the exact same thing. You got this resistance level now up here. It's trying to break through it. It cannot break through it today. If it continues, if it does break through and all of a sudden retest, reclaim support, that's going to be bearish for the markets. If it gets rejected and start heading back down, and obviously that will be bullish for the markets. Whether it be short term or long term, that's what we'll have to find out. Again, anybody tells you they know where the market's going is lying to their teeth, and they're just guessing what they're doing. They're drawing these charts and going, oh, wait a minute, it happened, right? And then when it doesn't happen, they don't say anything. But, again, this market, next week's going to be key as far as I'm concerned. Remember, seasonality-wise, the second part of February is usually rough, and then March and April are usually good months, and then we sell in May and go away, right? That's seasonality. Is that going to happen? We'll have to see. Also, the third year of the presidency, no matter who the president is, no matter what party they're with, usually is bullish as it started out that way. Will that play out? We'll have to see. Sometimes the big boys, they like to play that way, right? That's the reason why you saw a lot of people having these bearish bets going into the end of February, because seasonality-wise, it usually is weak. And so, again, we'll have to see. Inflation, hey, shocker, it's sticky. Remember, what do we talk about? We're going to get to that point where it's like barely moving down at all. How will the market react? Because everybody's like, it's going down like a meteorite, 0.6, 0.4 every month. Well, guess what? That's not the way inflation works. So, that's why a lot of people are saying the Fed will have to cause a recession to crush demand, right? How do you crush demand? People lose jobs. People don't have money to go spend anymore, right? What do you see happening right now? The savings rate is actually going back up. Doesn't surprise me, because why? People are pulling a lot more interest now than they did 5 years ago, right? And so if you just let it sit in the savings account, it's going to look like, wow, we're saving more money, because you're actually earning money on your money. And so, again, that makes it a little bit harder to kill demand when people are actually earning money on their money for once in, like, I don't know, it's been 13, 14 years, right, since that's happened. And so, that's where we're at on that. Let me know what you think down in the comments, what you're doing, where you think the market's heading next week. Do you think we're just retesting, going to do a turn, or are we just heading right back down that channel and let's resume the bear market, right? And so, anyway, hope you guys have a good day. I will see you Sunday.